1 week ago, the probability of a Federal Reserve rate hike in 2026 was 0. Not unlikely, not low, just 0. Today, that same probability sits around 37% on CME FedWatch. That's possibly the single fastest reversal in Fed expectation data in modern financial history, and almost no mainstream financial outlet is treating it like the front page emergency it actually is. The Cleveland Fed now has April headline CPI at 6.1%. The 30-year Treasury just broke 5%, and the S&P 500 is sitting near all-time highs, pricing in essentially none of it. Today, I'll walk you through exactly why this 0 to 37 shift just happened, what the data underneath actually says, and where the whiplash sits inside the 18-year cycle. So let's get straight into the data. April 28th, this time last week, the CME FedWatch implied a probability rate hike at any 2026 FOMC meeting at near 0. As of yesterday's close, that same number printed between 32 and 37% across multiple independent sources. 7 trading sessions, just 7 of them. In that same window, the rate cut probability collapsed from roughly 20% 1 month ago to between 3 and 8% today. Just to anchor you in on how violent this is, in January of this year, the market was pricing 2 full Fed cuts in 2026. Today, Barclays, Morgan Stanley, and Deutsche Bank have all officially abandoned their 2026 cut forecasts. The next cut is now being priced for late 2027. That is an 18-month delay in expectations that materialized over a single calendar quarter. The catalyst was the April 29th FOMC meeting. The Fed held rates at 3.5 to 3 3/4 for the 3rd consecutive meeting, but the language is what broke the market. 3 regional Fed presidents, Beth Hammack from Cleveland, Neil Kashkari from Minneapolis, and Lori Logan from Dallas, dissented against including any easing bias in the policy statement. They were not arguing for a hold, they were arguing the next move could be a hike, and the statement should not pretend otherwise. Powell stood at the podium and said, and I'm quoting him directly, "Nobody is calling for a hike right now. The bond market priced the contradiction in real time." Did you see it happen on the charts? Nobody is calling for a hike, and yet the odds say there's a 37% chance of one. When the chair of the Federal Reserve says something the bond market refuses to believe, the bond market is the one telling you the truth. So why did the curve move this violently? Because the underlying data forced it. Let's start with the PCE, the Fed's own preferred gauge of inflation. Headline PCE printed 3.5% year over year for March 26. That's the highest reading since May 2023. The monthly increase was 0.7%, the largest single month jump since June 2022. Core PCE moved from 3% in Feb to 3.2% in March. Now, overlay the Cleveland Fed Nowcast, the model the institutional desks actually trust. Cleveland Fed is now projecting April headline CPI at 6.1%. If the official BLS release in mid-May confirms anywhere near that nowcast, it would be the most extreme single-month CPI acceleration since the early 80s. April headline PCE is being nowcasted at 5.4%. April core PCE at 3.7%. The energy contribution alone is brutal, and we saw that in Australia as well. Gasoline prices surged 24.1% in March. Consumers spent an additional $83 billion on gas and energy in March alone, the largest single contributor to total nominal spending growth that month. National average gasoline is sitting at $4.30 per gallon, diesel's at $5.50 a gallon, and some California stations have already crossed $8. Now flip to the growth side. Q1 26 GDP officially printed at 2%, but the Atlanta Fed GDP Now tracker had been reading 1.2% going into the print. The beat came almost entirely from a bounce in government spending, not private demand. In Q4 2025, it was revised down to 0.5% annualized. Real disposable income in March came in at negative 0.1%, the second consecutive monthly decline. Households are spending more nominally and losing ground in real terms. CPI accelerating, real income falling, energy costs surging, GDP momentum decelerating. That is a textbook stagflation cocktail. And here's the part that makes it inescapable. Ottavio Costa from Crescat Capital just publicly called trimmed mean PCE useless as a policy guide, arguing it masks a true cost of living and is being selectively cited to justify cuts the data does not support. I tend to agree with him. US debt to GDP is sitting around 122%, and Treasury just raised its Q2 26 borrowing estimate to $189 billion. That's up sharply from a prior estimate of $109 billion. Roughly $9 trillion of Treasury debt has to roll this calendar year. You cannot push the funds rate to 6, 7, 8% when every additional point of the yield blows another hole in the federal interest expense line. The math doesn't close. So the Fed is basically stuck. Cannot cut without losing what credibility it has left, may have to hike to stay in front of the data, and the institution itself cannot afford the consequences of either move. Now, this exact configuration has appeared before, twice that is, and both moments are worth walking through because the present setup is genuinely the worst of both. Go back to 1971. Arthur Burns, recently appointed by Nixon, comes under direct White House pressure to keep policy accommodative through the 1972 election cycle. Inflation was already running hot. Burns folded. He kept rates artificially suppressed and lit the fuse on the inflationary spiral that ultimately required Paul Volcker's 20% interest rates to extinguish a decade later. The mechanism was simple. Political pressure leads to suppressed rates, which leads to entrenched expectations, which leads to lost credibility, and leads to a decade of stagflation. Now jump to 1994. Greenspan misreads the inflation curve and on February 4th delivers a surprise 25 basis point hike with zero prior signaling. Markets had been positioned for a continuation of the low rate regime. 7 hikes, that's 7, followed over the next 12 months. The 30-year Treasury yield ripped from around 6% to above 8%. Global bond portfolios lost more than $1 trillion. Some estimates put the figure as high as $1.5 trillion. Orange County, California, declared bankruptcy because its leveraged interest rate derivative book was wiped out overnight. That was 1994. That was a 54% debt to GDP economy and a $6.5 trillion bond market and a dealer balance sheet that could actually absorb risk. Now look at what 2026 combines. You have political pressure on the central bank, exactly like 1971, and you have sticky inflation forcing a hawkish pivot, exactly like 1994. You have the market complacency with the S&P near all-time highs, exactly like both. And on top of all that, you have a 122% debt to GDP backdrop that makes the Volcker solution mathematically destructive to the federal interest line. Every prior episode of this kind of expectation whiplash has resolved in major asset class repricing within 6 to 12 months. That's every single one. If a 1994 scale bond move landed on today's $9 trillion rollover calendar, the loss of value would dwarf anything in living memory. Look at what the institutional class did while retail was busy buying the Nasdaq's 13-day winning streak. Berkshire Hathaway just reported Q1 2026 earnings on May 2nd. 14 consecutive quarters as a net seller of equities. $8.1 billion of net equity sales in Q1 alone. A record cash position, now $394 billion. That is the largest defensive cash pile in the 60-year history of Berkshire. Greg Abel chaired his first annual meeting last weekend and basically said 3 things. 1, we will not hurry to deploy capital into subpar opportunities. 2, pretty much the whole stock market looks expensive right now. And 3, we are making sure we have enough money to act when prices crash. Well, he did not word it exactly like that. I'm embellishing a little bit. The Buffett indicator is sitting at 226% as of April 30th, roughly 2.6 times the historical average of 88%. Buffett himself once said 200% is playing with fire. We are 27 percentage points beyond that line right now. Now look at the institutional surveys. The Bank of America Global Fund Manager Survey from early April registered the most bearish reading in 10 months across 193 fund managers and $563 billion under management. Hedge fund gross leverage is reportedly sitting at an all-time high of near 293%, while the same desks are net underweight US equities by 37%. Maximum leverage, minimum net exposure. You can't make this up. That is a professional positioning for volatility and repricing, not for index continuation. The corporate insiders buy to sell ratio is sitting at 0.24, well below the 0.34 historical median. Insiders, the people with the best information about their own companies, are net selling at a rate that historically appears at a major top. Next, look at the sovereign behavior. Central banks bought 860 tons of gold in 2025. That's the 16th consecutive year of net purchases. When the institutions that issue fiat currency are systematically buying the alternative to fiat currency, that is a structural signal about confidence in the monetary system itself. 3 completely independent classes of capital, corporate, institutional, and sovereign, all positioned identically. The professionals are bearish on growth, bearish on inflation, and underweight risk. That is the cleanest cognitive dissonance on Wall Street right now. The S&P 500 crossed 7,100 in late April. The 30-year Treasury hit 5% on May 4th, the largest single-day move since March 20th. Two completely different futures being priced simultaneously by two completely different markets. Stan Druckenmiller has spent 4 decades arguing that the bond market leads the equity market by 6 to 9 months. Right now, the bond market is pricing a Fed that is stuck, an inflation impulse that is reaccelerating, and a fiscal backdrop that cannot absorb the medicine. The equity market is pricing a soft landing that the bond market explicitly refuses to confirm, and history tells us which one eventually wins. Now bring this all back into the framework. The 18-year real estate and economic cycle, originally documented by Fred Harrison and refined by Phil Anderson, has tracked credit expansion and land speculation for over 220 years. Fred called the 2008 crash 3 years before it happened, and Phil has been forecasting this exact period as the winner's curse phase for over a decade. Now, what we call at TIA Stage 5 always features expectation whiplash before the cycle rolls into Stage 6. The rate expectation reversal we are watching right now is a signal 2 of 3. Signal 1 was the home builders rolling over in late 2024 and putting in lower highs ever since. Signal 2 is what we are walking through today, the bond market repricing the Fed in a single week. Signal 3 is the gold confirmation, the moment when the metal breaks decisively higher and stays there as the dollar finishes its second half decline. The dollar declining in the second half of the 18-year cycle is something that we have seen every single cycle. As for metals, the jury is still out, but there are some good signs that gold is holding the ground for now. But if you want the full breakdown of how this fits into the 18-year cycle, the 7 stages, the signal stack, and how Phil Anderson's framework maps out the exact moment we're sitting in right now, I put together a free 3-part mini course that walks through all of this. As a quick breakdown, part 1 is the cycle itself and why it has repeated for over 2 centuries. Part 2 is where we are right now in the timeline. And then part 3 is how to actually position for what comes next. There is a link in the top of the video description where you can find the 3-part mini course. I've made plenty of videos on the 18-year cycle on my main channel, which you can find Jason Pizzino. There's a link in the video description for that too, but this is the cleanest place to start, is with the 18-year cycle mini course. Now let's bring it all back together. The 0 to 37 shift on CME FedWatch is not a forecast. It is a description of where we are. The bond market has stopped believing the Fed. The Fed itself is fractured along the most hawkish fault line since 1992. PCE is at 3.5% and accelerating towards 4%. The Cleveland Fed is now casting April CPI at 6.1%. The 30-year Treasury just broke 5%, and the Treasury is about to roll $9 trillion of debt into a yield environment that did not exist 90 days ago. Berkshire is sitting on $390 billion in cash, and the Buffett indicator is at 226%. Now, the fund manager survey is at the most bearish reading in 10 months, but sometimes that's a contrarian signal. The insider buy to sell ratio is at 0.24%. Central banks have bought gold for 16 consecutive years, and the equity market sits near all-time highs, pricing essentially none of it. The asset owners feel wealthy as the index pushes higher. The market can grind sideways, deliver one more squeeze, and still be sitting inside the same configuration we just walked through. But the rate expectation reversal is the warning the bond market is firing on every screen. And history tells you the equity market is the last asset class to capitulate to what every other market has already confirmed. In 10 days, Powell's term as chair expires. Kevin Warsh is expected to be confirmed on May 11th, walking into a fractured FOMC, a 6% CPI nowcast, 5% long bond, and the explicit promise to deliver what he calls a regime change in how the Fed conducts policy. His own language is more alarming than anything an outside commentator could say. So now I want to hear from you. After everything you just heard about the 0 to 37 rate hike whiplash, the Cleveland Fed Nowcast, the Berkshire Cash Mountain, and the smart money repositioning, where does this resolve? Does Kevin Warsh actually deliver a hike under political pressure to cut, or does something break in the bond market first and force the Fed back into the same liquidity facilities it spent 2 years trying to retire? Drop your call in the comments section. I'll be reading every single one of them and replying to as many as I can. As always, hit the like button, subscribe to the channel, and grab the free 18-year cycle mini course. There's a link in the top of the video description. Other than that, I'll see you guys in the next video or on my main channel. Until then, take care and peace out.